And we've got a few more seconds. It's 1 p.m. Eastern Time. Thank you so much, everyone, for joining today. We have a lot of registrants for this specific presentation. It's an interesting one, and it's very timely. 2024 condo budgets, aligning them with the new lending requirements, how reserves are impacting those condo budgets, how special assessments are impacting them, the issues that revolve around HOA insurance that we're seeing across the industry, and what we're seeing trending in engineering and reserve study reports. So thank you for joining today. As always, we encourage you to ask as many questions as you like. We typically can't get to it within this 30-minute presentation, and we try to make these presentations 30 minutes so you can get on with your day and get the important information we want to give you. So please ask the question in the chat, and we will review those questions. If we can't get to it at the end, which on this presentation I don't think we'll be able to, we will certainly send you an email back and respond to your question. So don't be shy about that, please. Without further ado, let's go into this. So today, I'm Orest Tomaselli. I'm the president of Project Review at CondoTek. This is episode 14 in our first season of providing these types of webinar presentations. We started naming them recently and actually putting episode numbers on them because so many people wanted to get a copy of them afterwards. We do post these episodes to our blog, so look for that in the next 24 to 48 hours once the recording comes back. And you can download this if you're not able to sit throughout the whole entire presentation, or if you have some staff member that has missed it. On this presentation today, I asked Lisa Geloso, who's head of our product operations and customer success at CondoTek, to join this call because she's really the expert in, what's going on in the industry from a lender's perspective, and she and her, team of underwriters review, hundreds of condominium developments a month. So I asked her to jump on. So welcome, Lisa. Thanks for joining me today. And as always, we go into a short little outline. We do provide several different services at CondoTek: the Condo Pack, which is our documents package, the Condo Project Warrant, which has become incredibly popular over the last couple of years, where not only do we obtain condominium documents, but we also provide a warranted review of those documents to Fannie Mae or Freddie Mac or portfolio lending guidelines, FHA guidelines as well. We offer our co-op pack, which is for cooperative developments. So if you're in an area of the country where you need to determine compliance on a cooperative loan, we offer that service as well. And then we offer our, what we like to call our retail services, which is, our Fannie Mae PERS, our FHA project approvals, our VA project approvals, and our portfolio lending approvals. We have recently started to really see an uptick in associations contacting us to try and get them off Fannie Mae's unavailable designation, or remove that designation. And it's been interesting. We've had some success there, dependent upon what the reason is for that particular project to be on. And that's kind of part of the conversation today that we're going to have. So we're going to talk about what the issues are. Whoops, a little too fast. So what's the current market environment? By and large, what we're seeing is that condo loans are becoming incredibly difficult to approve. With Fannie Mae and Freddie Mac's new guideline releases, which, by the way, I say this in every single presentation, the agencies are right. There's a lot of issues in this space, and there's a lot of risk for the agencies, in these condominium and cooperative buildings across the country, but specifically for condominium buildings. And we're seeing geographically that there's more risk in certain areas than others, areas that are prone to natural disasters or fires, like, states like Florida or California. And, these are kind of like obvious things that are happening out there. You're seeing the insurance industry change dramatically in those states and across the country. But by and large, we're seeing that condo loans are becoming very difficult to approve. And we're going to go through the reasons why. And part of the reason, of course, is, the budgets on these condominium developments. A lot of these buildings are routinely rejected. And sometimes it's for something really stupid. Their deductibles are too high on their insurance policies, or they haven't bound the right insurance, or they haven't completed a critical repair on the site. And what we're finding is that compliance is really secondary to cost. So if you ask a board, or a property manager that's representing a board, it's funny, some of the costs to get compliant, whether that's to reduce your deductibles on your insurance policy in order to become compliant, or obtain the appropriate HOA insurance, or increase your reserves, or amass some reserve capital and start funding towards the future, repair and replacement of components in the development. It's sometimes not that difficult of a process to align, but the slightest increase in cost, we have boards that are just saying, no, we're not going to, fund this reserve this way, and no, we're not going to change our insurance policy. Unit owners can't afford it, and that's starting to be, kind of a trending topic in the industry. So, compliance with agency lending guidelines is, we're not seeing the urgency as we thought we would see recently, over the last 4 or 5 months. We thought there'd be a lot of, urgency by boards in order to kind of get through the process of compliance and make sure that residential mortgage financing is available. And we haven't seen that. We've seen it in some instances, in some areas, but certainly not enough. The Fannie Mae unavailable designation, we're seeing increases in how many condominium and cooperative developments are being added to that list. And it's interesting, a lot of the reasons why the most recent buildings have been added is because of insurance issues and or budget issues. But primarily, I think insurance issues based upon the review that we recently performed. Jumbo and portfolio lending, what's happening there is that we've had, over the last 5 or 6 years, a lot of lenders who were providing residential condo mortgage financing, on new construction developments or in buildings that weren't compliant with agency guidelines. And we've seen this major pushback from these lenders over the last 3 or 4 months, where if the building doesn't meet Fannie Mae and Freddie Mac's lending requirements and their risk evaluation, then lenders are not really, interested in providing a portfolio approval or a portfolio loan in that specific development. And that's something that's really interesting. I mean, some of the LTVs that we've seen that have been rejected, I've seen 60 LTVs, 50 LTVs rejected for portfolio approval at some of the big box lenders, primarily because the property's insurance policy didn't comply with agency lending guidelines, right? So there's some issues there. And, unfortunately, I don't think those are going away very quickly. Lenders are really looking for saleable loans in the secondary market or to the agencies. And making sure that these buildings are compliant is really important right now. And the final kind of trending thing in the current environment is that boards are very slow to act and to make changes and make the changes that they need to make to be compliant. So I've attended probably around 50 or 60 board meetings in the last 6 months. I do, about, 10 to 12 board meetings a month with our clients. And boards are really slow, to change this insurance policy may take, $1,000 increase in cost, and sometimes it's much more than $1,000, but $1,000 increase in cost, and you have to call up your insurer to do it. Sometimes that takes 3 or 4 months to get that done. So boards are very slow to act, and we think that the trend is going to be that that's going to hopefully change in 2024, because this is starting to become a major issue for condo lending. So to the guidelines, and Lisa's going to handle a couple of sections in the next slides. I'm going to ask her for her expertise, but what we're seeing trending as far as 2024 condo budgets are concerned, and we're starting to review a lot of these, by the way. We're starting to see these draft budgets come across our desks, and some of these property managers and or boards are being told to just put a 10% line item in the operating budget for reserve, and that'll clear the site. And that's not true. When you look at the questionnaire and the questions that you need answers to regarding critical repairs, components that, have to be replaced, deficient repair work in a condo building, sometimes we're seeing that the 10% reserve line item in an operating budget is not enough. We're also seeing that's coupled with the fact that the association may not have any amassed reserves. So I think what's being told to property managers and associations via some sort of not complete reading of the guidelines is that a 10% line item being added to an operating budget is going to be enough, and that's often not the case right now. We're seeing HOA insurance cost increases, surging insurance costs. We have one development in New York, my state where I live in, where it happens to be on the water, but this isn't true for every building that's on the water, and it's true, this is becoming true for a lot of buildings that are in the city centers as well. There was over a 380% increase to their insurance costs between 2023 and 2024. Not only was there a 380% increase to the insurance cost, but the insurers now are requiring a reserve study in a lot of these instances just to provide a policy. I learned that little nugget on a meeting recently with a brilliant woman from USI, USI Insurance, who was talking about the issues that are plaguing the insurance industry. And it's true, we're finding from a lot of insurers that if an association doesn't have a reserve study showing that the building is in good condition, that they're not offered a policy. Or the opposite of that is essentially the fact that their insurance costs are surging so greatly. I was shocked at the 380% increase. So that's become an issue. And one of the ways that associations are combating that is they're increasing their deductibles. So once they increase their deductibles, they often run afoul of several of the guidelines or agency guidelines, and Lisa's going to run into it in a second. We're also seeing massive special assessments being added. We're looking at these budgets and we're seeing, $100,000 special assessment, $200,000 special assessment, which also can make you run afoul of the lending guidelines. And a lot of the engineering and/or reserve studies are either unavailable, the association doesn't have one, or they're expired. They're more than 36 months old. And when that happens, you have to go into, getting and sourcing additional documentation, because as a lender, you're required to make a determination. And that determination can come from the condo questionnaire if it's completed and the addendum is filled out completely, but often it's not. Or it can come from, getting a reserve study or an engineering report that's been performed to see that the property is in good condition and that there's no critical repairs necessary. A lot of times this is causing major issues and major delays and buildings being rejected. So let's get into it. How do you align a condo budget with, lending compliance requirements? Lisa, thank you again for being on this call. Can you please shed some light about the HOA insurance policy needs and what we're seeing trending in the industry and the issues that are coming up?
Sure. Good afternoon, everyone. Just to piggyback off of what Orest was saying a few minutes ago about HOA's increase in insurance. One thing that I want to point out is if you're looking at a master policy and it's renewing in 2 weeks and your closing's not for 3 weeks, what we've seen upon renewal is dropped insurance, dropped endorsements, building limits change, they add co-insurance. It's really, really important to note that when you're reviewing a policy that is up for renewal, to get that renewal, to make sure that it complies the same way that it complied with your first review. We're definitely finding that that is a trend and on the uptick. Some of the things that we're seeing with insurance policies that are either non-compliant or change upon renewal are underinsured. They're not insured to 100% replacement cost. The per occurrence and per unit deductible is out of compliance with agency guidelines. We're seeing a lot of ACV. We're seeing a lot of actual cash values specific to the roofs, which is completely non-compliant. We're seeing multiple unaffiliated policies that don't have dedicated coverage amounts. So when you see your master policy that has multiple unaffiliated, you need to obtain the policies dedicated for each of those coverage amounts. Again, the endorsements, they're either missing, or upon renewal, they were there and now they're not there, such as building ordinance and law. I've seen a huge uptick in that lately. Inflation guard, waiver of subrogation, severability of interest, so on and so forth. The agencies require that the master policy be on special form. However, when you get special form, there could be excluded perils. You need to make sure that you're not missing any of the required perils, such as wind, hail, sinkhole, etc. If it is missing those perils, or if it, you need to make sure that there's another policy in place to cover that peril. We're also seeing a lot of missing flood insurance. That's really easy. As a lender, you can run your flood certificate, see if you're in a flood zone, and then just making sure that the HOA is properly insured for the flood insurance. And those are the trends that I'm seeing currently on the insurance. Orest, then I'm going to hand it over to you for your next segment. Not sure if you're going to reserve or reserve study engineering.
Reserves, but let's stay on insurance for one more second.
Sure.
I mean, literally, it feels like you have to be an insurance expert, not only to review the policies, but I mean an expert master, to review these policies. What we often find, by the way, and I think it's important to outline here, is that, a lot of our lender clients have expertise in reviewing insurance policies. But the first review versus the second review, or the additional policy, if we, there are missing required perils and we need to see a secondary policy, or we need to see, some sort of aspect of the insurance policy that's changed or is changing, especially on a 2024 budget, or for 2024, I should say. It's happening regularly. Right? We're seeing massive changes to insurance policies. And why? The reason is because these costs for insurance are surging so much that associations and their brokers and their managers are doing everything they can to keep maintenance down. And one of the ways that, unfortunately, they try and do that with is to, increase the deductibles of insurance policies or have less coverage. And we are running into this daily. I spoke to a very large lender recently that within the last 30 days, they had over 200 separate loans in separate buildings rejected as a result of the review of the insurance policy. One of the largest lenders in the country. So this is not something that's, this is incredibly common, I should say, and it's not just for the smaller lenders or lenders that don't have access to major investors. It's happening everywhere. So, insurance is a big issue right now. Reserves, again, what we're seeing, especially in 2024 budgets, is that as we're reviewing these over the last couple of months, we're seeing that, yeah, sure, we see some buildings that are adding a 10% line item into the operating budget for reserve, but they may have $200,000 or $300,000 in repair work that needs to be done over the next year or two to some critical components in the building, and they have $25,000 sitting in a reserve account. that's an issue, right? It's not just to check the box anymore. And when you're looking at the 10% reserve line item, it's really only step one in your review, right? You need amassed reserves. We need to see, the agencies need to see, and from a risk perspective, you need to see that the building isn't going to fall into the trap of a special assessment and cause a financial hardship for the unit owners. It's, really important to look at these budgets really, really, really sharply in order to make sure, and critically, in order to make sure that, they make sense. Critical repair costs have to be reserved for. You need to have that capital sitting in your account. And of course, the critical repairs have to be completed in order for a building to be warrantable. And some lenders and some secondary market investors, especially in the portfolio world, are looking for historical contributions, right? They want to see that the building has been amassing reserves, that they haven't like spent every dollar at the end of every single year, which was like kind of like a hustle. They would put a 10% line item in, get that capital and spend every dollar of it. The agencies and investors and the secondary market really wants to see that, condominium developments are operating in a financially healthy manner. Reserve studies and engineering reports, another big topic that's coming up right now. So it should be said, not all reserve studies are created equally, and not all engineering reports are the panacea to outline whether or not a building, can pass muster with agency lending guidelines and or secondary market lending guidelines. We see a lot of reserve study reports that don't have a professional engineer inspection. Not to say that, reserve specialists can't do reserve studies, because they can, but you have to take it and look at it with a different lens. If you have a professional engineer inspecting a property, they have a license and they're a professional engineer. That designation alone means that there's an extra level of scrutiny on those components in that property. We're seeing that also engineering reports are, sometimes only on a really specific component in the building or section of the building, like this corner of the building, the structure there is sound. But they don't talk about the rest of the building, right? They don't talk about the rest of the components. So often we find that we'll get an engineering report, but it really only covers a small issue or a small issue that may have occurred in the property, but it doesn't outline, the rest of the components in the building or the rest of the, structural or mechanical condition of that building, which, as we all know, you need to make a determination on. There's a 36-month expiration on these reports, and if the reports are there and available and they're less than 36 months old, there's a mandatory report review. Again, a lender has to make that designation whether or not a building is warrantable with the structural, mechanical, and financial requirements. And if they don't have the reserve study and they don't have the engineering report and the questions aren't answered on the questionnaire, there's no way really for them to make that determination. For us, it's incredibly difficult to try and source additional information on a building when we get a request if we don't have those documents. Often, by the way, and it's important to outline this, we're seeing that questionnaires now are being answered without the attestation of structural and mechanical condition, and we're being delivered a reserve study report or an engineering report for review. I mean, that's fine. If I have an engineer's opinion on a building and it's been done within the last 36 months and the board doesn't want to answer questions about, the structural condition because they don't have the expertise, give me the expert's report. I'll look at it all day long and make a determination from that and the associated other documents that we pull, whether it's violations or, any other searches that we look at. So it replaces the warrant. So I think, from a trend perspective, you're going to start seeing a lot of reserve study and engineering reports being delivered alongside of condominium questionnaires. And then our final kind of section today is really on the special assessment, because the special assessment is always been an issue The guidelines didn't change very much for special assessments. Of course, I'm referring to Fannie Mae and Freddie Mac's lending guidelines and their recent September 18th update. But what's interesting about the special assessment, and Lisa's going to go into a little bit, is we're really delving deep into what the special assessment is for and what the historical contributions have been in the building and to reserve in the building. And it's funny, it's opening up a lot of additional kind of questions, and it's become a little bit of a minefield. Lisa, do you want to explain what the issues are here?
Sure, there's definitely been a heightened focus to amass information, particularly if you're selling to Fannie Mae, because Fannie Mae now requires that you enter your project information into CPM. CPM has a cascade of questions regarding special assessments. It's not only the term and the amount that's clearly needs to be identified. If it's attached to a critical repair, the critical repair needs to be completed, but it also needs to be explained. Whether there's water or mold intrusion, or whether it's structural, or it's roof, or it's siding, or it's foundation, amassing that information, particularly for our clients that sell to Fannie Mae, is required. They're also focusing on the ability to pay, whether that's at the unit level or at the project level, not to be more than 15% delinquent. And then the overall financial health of the financials of the project based on the amount of the special assessment. So, here at CondoTek, when we're working with the HOAs and we're working with our lenders and a special assessment comes up, there's always a lot of query into, how come this is taking a little bit longer? Why do you need so much information? And although Fannie and Freddie basically share the same guidelines when it comes to special assessments, the cascade of questions that need to be answered within CPM, it can be voluminous collecting that information. We do it, we get it done. And just for those of you that aren't our clients, we did want to give you the message that amassing that information and getting as much information about that special assessment, and whether it's related to a critical repair, and breaking down the components and the elements affected, is really important.
Yeah, I mean, look, we're the data aggregators in the industry who are providing some of this data to us are starting to figure it out. They've been kind of slow to kind of get to the point where they're providing the appropriate data about special assessments or insurance policies, for that matter, or any of these things. And we hope they get better. Our hope is that they're going to get better in providing the information that's necessary in the near future. But as of right now, as of today, it's difficult to get this documentation in quickly, efficiently, and accurately. So thanks, Lisa. There's a couple of other points I want to make. By the way, Lisa is like, my go-to. She has the answer, I think, for every single question I think I've ever asked her. And just brilliant in her kind of review and analysis of projects. So, if you are working with us, please, I know she gets a ton of emails every single day, but please utilize her knowledge. Because I think you'll have a hard time finding better in the industry. As always, we provide some articles and links: the Fannie Mae lender letter, the Freddie Mac bulletin regarding their new guidelines, and of course the Fannie Mae FAQ link, which I love. Right, I love this FAQ. I think it's fantastic. We are going to provide some additional webinars over the next couple of months. The next few are slated to be, the next one is slated to be regarding new construction condominiums. This has become a really big topic right now. And we have been asked multiple times to provide an outline and an analysis of what has to happen in order for these new dev projects to be approved for Fannie Mae, Freddie Mac, and portfolio lending approvals, dependent upon where you are in the country. Some states, lenders in some of these states focus on new dev, and they will provide residential mortgage financing to purchasers through their portfolios with as little as 15% of the units in contract. There's a lot of solutions that we provide to our new construction developer clientele, which is huge. By the way, we have a lot of developers across the country utilizing us, and a lot of lenders who do that type of business. So that's going to be an interesting webinar coming up, I think, within the next month. We're going to pick a date. You'll probably get an email about that. As always, you can always email Lisa or I, call us. We're happy to provide you with answers, guidance when we can. And we thank you so much for attending these webinars, because we think that the more information we can provide, especially about the fact that we really agree with these agency lending guidelines from a risk perspective. I don't think they're going away for a long time. And we have to adapt and adopt these, review practices into our process in order to be able to do condominium loans, and do them compliantly and effectively. So thank you. This presentation will be available, I think, within the next 48 hours on our website. And if there were any questions, we'll try and get back to you on them shortly. Thanks, everyone.